Okay, we're going to finish up this video with the rest of the transactions from this chapter. So we'll pick it up with the payment of an additional expense. Looks like we've paid some salaries. So we will, again, we've got just like the rent, salaries is an expense. When an expense, when we incur more expenses, that's a debit. And then we paid that with cash. Our cash goes down. That's a credit. And then we wander on over and we post those in their respective debit and credit columns in their individual accounts. And on we go. All right, so we've done a little bit more work here. We've provided some consulting services. So, and rental as well. So this is kind of a twofer on this transaction. And those were, I guess we have a tenant that we also do work for. So, So anyway, this tenant, however, is not going to pay us for the rent or the consulting services at the time that it's due. He's going to owe it to us. And that is an accounts receivable, because we will at some point receive the money, which is also an asset. And so the balance in the accounts receivable will be recorded for the entire $1,900 he owes us, which is the consulting services plus the rent. However, we're going to split those up on the credit side of it, because we want to separately know how much at the end of the year that we had in revenue from our consulting work versus our rent, because it's important to keep those separated so that we can keep track of where our money comes from. And we move on over to the individual ledger accounts, and we transfer those entries over so that we can keep track of those balances. And we got a whole whopping total of what, $5,800 in consulting revenue at this point, and we have $300 in rental revenue. Now we've actually now been paid for the transactions that we recorded in the last slide here. So that $1,900 we now have received in cash. So our cash goes up, that's a debit. And our kindly tenant customer, we want to make sure that we reduce the balance in the accounts receivable to show that he's paid us or she's paid us and doesn't owe us anymore. And so we're going to credit that. And again, these are both asset accounts. We wander over and we record those into their individual ledgers and on to the next transaction. And so now we are going to make a partial payment for one of the transactions that we had earlier, and I can't now remember what we bought. But anyway, we had an accounts payable that was outstanding that we owed to somebody, and we're going to not pay all of it, we're going to pay part of it. So our accounts payable is now going to be a debit, which is going to reduce the balance in the accounts payable account that shows that now we're going to owe a little bit less than we did as a result of having made this payment. And our cash is a credit. We spent cash on this payment, so we have less, our cash balance goes down, and that's a credit. Also then transferred into the ledger accounts. And on to transaction 11, where our owner decided to take some money out. Not a lot, $200. I guess they're entitled to do that. So we want to record that as a withdrawal. So remember, when the owner takes money out, we're not going to record that against the owner's capital account. It's going to go in a separate withdrawal account, and those two accounts are going to work together to establish the balance of the owner's equity. And so a debit balance will increase and you think, well, he's taking money out. Why is that an increase? Well, we treat it as an increase because we are keeping track of how much he has taken out, and the balance of what he has taken out has now gone up. The total money he's taken out has increased as a result of taking that withdrawal. Our cash has gone down as a result of taking this, so that's a credit, and hopefully you're not totally lost at this point. Now we're going to get some cash for future services, and this is where things can get a little dicey, and I had talked about a little bit earlier where we would address unearned revenue. When somebody pays us money and we haven't done the work yet, we can't record that as revenue because if they fire us, we got to give the money back, and we haven't actually done anything to earn it. So we don't want to record revenue unless we truly have earned that revenue. But we did get the cash, so we're going to record the cash. Our cash balance is going to go up as a debit. And then we've got this unearned consulting revenue account. Now, don't be misled by the title revenue in that. It's not a revenue account. It's actually a liability account. And why is it a liability account? Well, again, if we get fired and the customer decides he hates us and wants his money back, it's going to be something that we're going to owe the customer potentially up until the point that we've actually earned the money to be able to record it as revenue. So we're going to treat that as a liability, as an obligation that we owe. And that's going to get recorded in an unearned consulting revenue. You could just call it unearned revenue. The titles of these accounts can be customized a little bit from company to company, depending on the nature of the work that they do. So again, those get recorded into the individual accounts. And so now we've got insurance that we're paying. Now, you might say to yourself, okay, well, why isn't insurance an expense? Well, let's say you buy a car and you pay the entire year's premium for that car on the day you buy it. And then 3 days later, you're driving this car and you think, I wish I hadn't bought this car. I hate this car. Didn't really like the car. And maybe you take the car back to the dealership, or you sell the car, and you somehow you get rid of the car. You don't need the car anymore. Well, you've paid an entire year's worth of insurance on a car you no longer have. Guess what your insurance company is going to do in that case? Are they going to get to keep your money? No, they haven't earned it. You're going to get a refund. So until you have used up all of that insurance money, we're going to consider the part of that you haven't used as an asset. And so it's going to, at the moment we pay it, go into an account called prepaid insurance, which is an asset. Our cash will go down by the $2,400 that we paid. And then we will talk in future chapters about how we adjust that prepaid insurance account as the year goes on and we use up more and more of that annual insurance premium. But for now, don't worry about that. Just know that when you make the initial payment, the entire thing goes into a prepaid insurance account, and then you're going to credit your cash by the amount of money you spent. We purchased some supplies for cash. Hopefully you're saying, whew, something I recognize. So again, we've got cash, we've got supplies. Our supplies went up, an asset goes up, we record a debit. Cash, also an asset. Cash goes down because we spent our cash. When an asset goes down, it's a credit. And then we record those into the ledger accounts, and we move on to what I believe is our last transaction. No, I lied. Got one more. Okay. So we've paid some expenses for cash. We had some utilities that we paid. So again, when we have an expense that we record when we record an expense, that's a debit. Our cash again goes down as a credit as a result of having paid out that money, and then recording in the individual ledger accounts. Now we're at the last transaction. So we paid some more expenses in cash. We paid some salaries. So just as we did when we paid the salaries before, we have a debit to the salaries expense account and a credit to cash. Now, it may be useful at this point, or maybe not, to go back to Chapter 1 slides, because this is at the point we were at Chapter 1 where we had listed all of these transactions out. This is just like that, except now we're showing them in ledger form. So these are all the entries that we just recorded, and now they show up in their individual accounts. And again, you know, notice how they look like a T. Debits on the left, credits on the right. And then they kindly sort of put here in white the revenue and expenses so that those are kind of highlighted. And you'll see, you know, why in a second. But again, still under equity, but those are going to be treated on their own financial statement in the next video. So I'm going to stop this here and move on to the next video to move into financial statements.